Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Asian equities edge higher after a rocky start to the year for US stocks. Concerns about China's economy push the 10-year yield below 1.6% for the first time. South Korean investigators failed to arrest impeached President Yoon Suk Yeol after being blocked by protesters and his security team. And the FBI finds no evidence linking the deadly attack in New Orleans and the Cybertruck explosion in Las Vegas on New Year's Day, despite similarities between the incidents. Well, a very good morning. Happy Friday. And we are looking at futures pointing lower in Europe, higher in the US. But we had another session of disappointment in the US yesterday. Tesla results weighing on US stocks, and we're going to dive into that. But flipping over to the cross-asset picture this morning, we have Japan still on a holiday. So we await cash trade in treasuries. That shall start at the top of the hour. But euro dollar at a 102 handle currently. We saw that dollar strength as US initial jobs claims fell to an 8-month low. And on the flip side, this euro weakness. We are still on parity watch, of course, as we await news about Trump tariffs on Europe, fears about another energy crisis, and the political uncertainty in France and Germany. Meanwhile, gold steady pretty much there. Brent trading at $75 a barrel and Bitcoin at $96,000, dipping for the first time in 4 days. But if we flip again, we can check on Asia markets as well. As I say, it's been a dismal start to the year in Asia, a historically bad start for China, and now trading in a tight range on the CSI 300, down 0.7%. The yen pretty steady at 157 per dollar. But let's get back to those attacks in the US. Investigators say that they've actually found no evidence linking the two attacks in New Orleans and Las Vegas, but the FBI continuing to examine the two incidents that really rattled Americans as they rang in the new year.
There's also an FBI investigation in Las Vegas. We are following up on all potential leads and not ruling everything out. However, at this point, there is no definitive link between the attack here in New Orleans and the one in Las Vegas.
Let's get more now with Bloomberg's Derek Wallbank. And Derek, really America on tenterhooks for more details here. But what have we actually learned in the past 24 hours since the attacks?
Yeah, that really is the case. There's been a lot of unease, a lot of uncertainty, and a lot of disquiet about the fact that these two events could have happened. They did happen in close proximity time-wise to each other. One in the heart of New Orleans, very big tourist city. The other one in Las Vegas, which needs no introduction as a tourist mecca of its own. Right? The FBI is saying, as you noted, no definitive links between there. They have not been able to establish that one was directly to do with the other. However, as you noted, there are some similarities there. Both of the people suspected to be involved in both cases were both members at one point of the U.S. Army. Although there's way more people who serve who have no difficulties at all. You know, you couldn't possibly suggest anything like that at all. So I think investigators right now are trying to figure out what could have been going on that would have prompted these things, because I think right now, candidly, the fact that there has not been any suggestion of what has put these two things so close together has a lot of people on edge. I do also think that there's going to be, I would say, a pretty significant security response in places that have a large amount of public gatherings, and one of the biggest ones of those is going to be Donald Trump's inauguration in Washington, D.C. coming up later this month. Now, that is going to be, I think, a very, very big security posture moment anyway, but you can and should expect that all of those security plans are going to be run over with an even finer tooth comb going forward.
All right, Bloomberg's Derek Wallbank, we thank you for the update on those two attacks. Now to South Korea, where authorities have failed in their attempts to arrest impeached President Yoon Suk Yeol due to resistance from his security team and protesters as well. Bloomberg's Katya Dmitrieva has been tracking all the developments for us. We could speak to her now. Katya, what are the likely next steps if and when Yoon is arrested?
Well, we're kind of finding that out by the minute right now. You know, we had the special investigators showing up at Yoon's residence this morning, kind of the latest in this ongoing political turmoil. Of course, meeting that wall of protesters who were pro the former president, the impeached president, as well as his security staff. And so they were forced to pull back just for safety purposes, really, because when you have that sort of matchup, you kind of want to avoid, especially with civilians, any kind of issues. So the question now becomes, you know, what comes next? Can the CIO continue? What we know is that this arrest warrant is valid until January 6th. So it's still a few more days that they could attempt to do this again. The CIO is going to be hosting a press conference later on today, and they're kind of going back to the drawing board. You know, they're pulling back for now. Earlier today, there was about 1,700, or just under 3,000, I should say, police officers at the scene, as well as this private investigation unit. So they have to decide whether they want to do that again or whether there's another way of approaching this.
And I'm looking at the Kospi and the won both up. Are analysts expecting the arrest when it comes to have much market impact, or is it really already all priced in?
Yeah, it hasn't really moved the markets this morning. You know, we were expecting, going back to how we first got here exactly a month ago on December 3rd when martial law was declared, and then right after that, the sort of weeks that followed of impeachment and the new president and his subsequent impeachment as well. We saw the won falling, as well as the Kospi, the local stock index, kind of gyrating for the past few weeks. But today, things are actually not looking too bad. I think, to your point, a lot of this is priced into the market, especially when it comes to the currency. You know, you even had the past few days, the past 5 days, the Kospi sliding, and today sort of up a little bit. So the question is now, what happens next with Yoon? I think there's an assumption that there will be a development there, that he will be either arrested or there will be some sort of election process. You know, it is a democracy after all. So really, the bottom line is just wait and see. And the next couple of days, I think, will be very crucial for that.
All right, Bloomberg Katya Dmitrieva, we thank you for keeping across this drama blow by blow as it unfolds. And we are keeping track of it on the terminal on an excellent, I have to say, live blog, which subscribers can find by going to TLIV Go on the terminal. Now, to markets, US markets indeed have been having a rocky start to the new year. Equities lower for a fifth day. We can get more now on what's driving that sour sentiment with Bloomberg's Valerie Teitel. Welcome back, Val. Talk us through all the latest moves.
Lizzie, it was a rocky start and also a very volatile start for the year for the U.S. equity markets. The S&P 500 had a near 2% swing intraday in yesterday's trade. It tried to rally but ended this session lower, and it snaps now a 5-day losing streak for the broad U.S. benchmark. Another eye-catching move yesterday, Lizzie, was the strength in the U.S. dollar. Again, we've started the year off with a bout of dollar strength, and most of that versus the euro. The euro sinking below that 103 handle. And this is very interesting, Lizzie, because euro pessimism is very much a consensus position out there. We know in January, sometimes consensus positions do get squeezed. We have not seen that yet. That euro dollar continues to trade lower. We are now below the 103 handle at 102.73. And lastly, another eye-catching thing, Lizzie, is overnight in the Asia session, the Chinese picture somewhat moderated a bit. We do have the Hang Seng, those Chinese stocks in Hong Kong. Those are positive. The CSI 300, which saw a near 3% slide yesterday, is still to the downside, down 1%. And those China bond yields are moving lower. Again, we have a weaker Chinese economy. Combine that with a weaker inflation outlook for China and the hopes of further further monetary stimulus, all a very supportive environment for bonds in Asia, especially those in China, that rally continuing in the Chinese bonds.
Yeah, those PMI numbers yesterday really knocking Chinese stocks to kick off the start of the year. Meanwhile, though, Val, US banking system reserves at the Fed at their lowest since October 2020. Talk us through why that is.
Look, a lot of attention on banking reserves recently, Lizzie. We have the Federal Reserve's QT program still ongoing. Many do think it is going to come to an end at the beginning of 2025. And why is that? It is because banking reserves have dropped below $3 trillion. Many analysts out there see that level as the comfortable level of reserves in the banking system. So we might risk another repo funding squeeze if banking reserves dip below much further than this. But this is a good thing to watch out for, Lizzie, as the expectations of when the Federal Reserve might end their QT program ramp up.
All right, good stuff. Bloomberg's Valerie Teitel, we thank you. And coming up on the programme, it was a stellar 2024 for South African bonds, which outperformed other emerging market countries and generated a total return of a whopping 14%. So we're going to take a closer look at the Rainbow Nations economy next and what 2025 might have in store for it. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's just gone 6:13 in London. But let's go to South Africa now, where the second half of last year saw the country's bonds the best performers among 18 other emerging markets, generating a total return of 14% across 2024. Now, the coming to power of a ruling coalition, the first in 30 years between the ANC and the Democratic Alliance, boosted investment in South Africa's currency, equities and bonds. So we can get more now with Bloomberg News Editor-in-Chief Emeritus Matt Winkler, who's been digging into the subject and joins us now from New York. Good morning, Matt. I mean, no one saw the rand's strength in 2024 coming, really, but nor was the rewriting of South African political history a given. So since the strong dollar didn't seem to knock it last year, will it last in 2025?
Well, you know, the real test, and it's great to be with you, is the Federal Reserve, as you know, has kept a very restrictive credit stance. And as you just mentioned earlier in your program, just about every currency that is a major in the world, whether it's the yen or especially the euro, has depreciated significantly against the dollar, particularly with the Fed's credit policy. The fact that the rand of all currencies, which essentially has been one of the worst depreciating assets of the 21st century, is, if you will, keeping its halo at this point, is surprising and bodes well for what this new government means. And it essentially means business. You've had a history, unfortunately, of one-party rule pretty much going all the way back since the end of the unity government of Nelson Mandela. And now, for the first time, you have a coalition, as you said, which came about in June. That wasn't predicted, by the way, at this point last year. And that coalition actually is pro-business. And that's why not only is the rand relatively strong, one of the few currencies holding its own against the dollar, but also, as you said, the bond market has been resilient, and even the stock market has outperformed the world benchmark. And that is just unprecedented for South Africa.
But, I mean, is it safe to say now you've got Forex and debt markets showing confidence in the government that this is going to be a self-reinforcing positive loop?
Well, here's the thing. Whatever doubts persist related to unremitting crime, corruption, insufficient infrastructure, South Africa's gross domestic product has been upgraded 8 times since March to almost 1% growth in the fourth quarter. That's the most optimistic average forecast of 10 economists who contribute their research to Bloomberg. They now say GDP will expand 1.6% by the end of 2025. And that's based on this expectation for slower inflation, which arguably is the most definitive measure of investor confidence. And that really has turned favorable with the ANC losing its parliamentary majority. And you can see that in the bets that are being made across all markets. And it's kind of a symbiotic relationship because when you look at the CPI now, it's down to 2.9%. That's as of November. That's almost half the level at the start of 2024. So these are all very constructive indicators, and the fact that they're happening, as we noted, reading the new year, where we are now, is first of all, we haven't seen anything like this before, but second of all, it is very encouraging.
So what are the main risks now to the rand and bonds?
You know, Abraham Lincoln once said, I'm too familiar with disappointment to be very much chagrined. And, you know, that is the story here, is there have been so many false dawns with South Africa. But the fact that the markets are holding their own is really a important inflection point. And you can say the election did change everything for investors, at least. And that is pretty strong stuff, given what we're seeing right now across the world with debt, equity, and currency. Our own, economist for Bloomberg Economics sees the growth outlook accelerating to something like 2% in the months ahead, and to more than 3% over the next 10 years, from less than 1% during the past decade. If that indeed happens, the picture for South Africa has changed dramatically.
And what are the main challenges in terms of infrastructure? And you mentioned crime as well, and governance too, as we look ahead to 2025.
Well, the fact that you have, for the first time in more than 2 decades, a coalition government that is focused entirely on getting things done. That's what I mean by pro-business. That is very different from what has prevailed with a one-party rule that the ANC had pretty much since the beginning of Mandela's unity government, 30 years ago. So, yes, the risks are still there, but it seems like there is a willingness to accept a kind of government that South Africa really hasn't had since the end of apartheid.
All right, Bloomberg's editor-in-chief emeritus, Matt Winkler, wonderful to speak to you this morning. I'm off to change my email signature to this Abraham Lincoln quote right now. Thank you so much. Now, coming up, Tesla reports its first annual sales drop in over a decade, shares tumbling. We're going to dive into that fallout next, so do stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, as I say, we had the Tesla results yesterday weighing on US stocks. Tesla shares sinking almost 6%. And this was after the company reported its first annual vehicle sales drop in over a decade. The company selling 1.79 million vehicles last year, which was slightly less than it delivered in 2023. And we can dive into those results now with our Asia transport reporter, Danny Lee. He joins me now from Taipei. Danny, I thought that Elon Musk was really cozy with Donald Trump, that his business was going to be off to the races, and yet Tesla shares falling on this first in a decade drop in sales. What's going on under the hood?
Yeah, Tesla shares have been rallying significantly of late through 2024. But when you look at the hard numbers, the fact that we've had this first fall in annual sales in a decade, sales falling 1%, it's really a disappointment to investors, and in particular where you see the stock falling, because Tesla had been guiding towards a slight gain overall. And so by not being able to meet that kind of guidance it had been telegraphing is a big disappointment. You see the shares falling accordingly. And you just look at the hard numbers here in the fourth quarter, looking carefully, like Tesla had posted sales of 495,000, lower than the 512 expected by the street, and still lower than the 515 you needed to actually deliver that slight growth. So frustration. It is a surprise given how much Tesla had been trying to drive those sales through promotions and incentives towards the back end of the year.
I mean, interesting to see Morgan Stanley pointing the finger at Tesla's aged lineup. How much is that aging lineup costing Tesla? How much is it reflected in the sales figures?
It's that aging lineup, and it's also that very narrow lineup of cars, of EVs that Tesla produces and sells overall, which, it hasn't produced another mass market model for several years now. And, Tesla does have a pipeline going forward, which is well telegraphed. But we've obviously seen the Cybertruck, which is a more narrow set of vehicles. But there is expectation that this budget vehicle for $25,000 that Tesla has been talking up about could arrive in 2025. That could help rejuvenate sales and capture a bigger slice of the consumer that Tesla has yet to reach out to, and particularly compete more effectively against those challenges of the Chinese EV makers, of which Tesla only just managed to retain its crown as the world's biggest EV seller to BYD by only 25,000. So the challenges are there, and the competition is really breathing right down its neck.
Yeah, we've discussed that rivalry earlier in the week, Danny, but I wonder whether these results from Tesla change the narrative more broadly for EVs.
I think for Tesla, given it had so much to do towards the back end of the year, I don't think it changes the fact that, when you look at someone like BYD, even Tesla, frankly, that they are still in a pretty robust position compared to the rest of the legacy auto maker sector, who are laggards and find it difficult compared to brands such as Tesla, who can still attract many, many thousands of sales.
All right, Bloomberg Asia transport reporter Danny Lee, we thank you. I'm not sure if Teslas have hoods or whether you have to put your stuff in there, but nonetheless, thanks for looking under the hood with us. Now to some other stories making news this morning. We stay with tech. Apple shares slipping after Reuters reported that the iPhone maker is offering discounted smartphones in China. The fourth down day marks Apple's longest losing streak since November, and Reuters says the discounts will run from January the 4th to January the 7th, knocking 500 yuan off the flagship iPhone 16 Pro and the Pro Max. Elsewhere, China is planning to tighten export restrictions on some technology used to make battery components. Proposed measures include tightening battery cathode preparation technology and curbs on extracting gallium and lithium. The move comes a month after Beijing responded to US technology curbs by banning several materials with high-tech and military applications. China controls nearly 85% of the world's battery cell production capacity. And Bloomberg understands that President Joe Biden has decided to block the sale of US steel to Japan's Nippon Steel. The official announcement is planned for later today. The Washington Post earlier reported senior advisors raised concerns that the move may hurt relations with Japan and tried to sway him not to make the move. And Citadel has offered clients the option to cash out profits after a roughly 15% gain in its flagship strategy last year. However, the vast majority opted to keep their money in the multi-strategy hedge fund. Bloomberg sources say only about $300 million out of billions of dollars in profits was redeemed. Keeping profits with high-performing hedge funds is a boon for investors who are increasingly running out of options to allocate money. Well, those are some of our top stories this morning. Coming up on the programme, more gas concerns in Europe after an unexpected outage added to worries about supply issues. We'll bring you all the details next, as we look at futures pointing higher stateside and pretty flat here in Europe. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Asian equities edge higher after a rocky start to the year for US stocks. concerns about China's economy pushed the 10-year yield below 1.6% for the first time. South Korean investigators failed to arrest impeached President Yoon Suk Yeol after being blocked by protesters and his security team. And the FBI finds no evidence linking the deadly attack in New Orleans and the Cybertruck explosion in Las Vegas on New Year's Day, despite similarities between the incidents. Well, happy Friday. Welcome to the programme. If you're just joining us, it's just gone 6:30 a.m. here in London. And checking in on these markets, we have futures flat to the downside in Europe, mildly optimistic on Wall Street. But we did have a pretty disappointing session in the US yesterday. We were just discussing those Tesla results. They were weighing on the S&P, which fell for a fifth session yesterday. But if we flip over to the cross-asset picture, Valerie Teitel was talking us through that dollar strength for us. US jobless claims falling to an 8th-month low. And then on the flip side, euro-dollar weakness. We are at a 102 handle currently. We remain on parity watch as we monitor the fears about Trump tariffs on Europe, fears about another energy crisis, worries about the political uncertainty in France and Germany, both of which we shall dig into in a moment. But meanwhile, gold at $75 a barrel, pretty steady, as is gold, and Bitcoin trading down today. $96,000 is where we are, and that's the first dip in 4 days. But flipping over to Asia as well, it was a historically dismal start to the year yesterday, but Asian equities do seem to be back on the front foot this morning. China stocks trading in a tight range after that 3% tumble yesterday. The yen pretty steady there at 157 per dollar. But we should note, Japan still closed for the holiday, and that's why we've got no trading cash treasuries until the top of the hour. But let's dive into that energy story. European gas prices rising yesterday after a transit deal for the Russian pipeline flow through Ukraine expired at the start of the year. An outage in Norway and the cold snap also boosted prices, and we can dive into all of it now with Stephen Tapczynski. He joins me now from Singapore. Good morning, Stephen. We saw benchmark prices closing at their highest since October 2023. The question, I suppose, is whether that rise is going to continue given the cold weather.
Yeah, I mean, the market is certainly tighter now that they don't have the Russian supply. This is something that the market was also expecting. So this has been priced in. And you saw yesterday, very briefly, prices actually were a bit negative for a little while until there was news of an outage in Norway, or Norwegian, the Hammerfest LNG export facility. That'll be shut for about a week. That shot prices back up again and ended the session up to the highest level in 14 months. But that all together, that illustrates just how on edge the market is. Any disruption, any increase in demand because of colder weather is going to tighten the market. It's going to result in more withdrawals from storage. And the more you take out of storage, the more you have to refill later. And that's just naturally going to increase the prices now and across the curve for summer and then potentially next winter. So every movement, every outage, even if it's just for a week, even if it's just a cold snap for a few days, even if there's no wind just for a little while, that results in more gas consumption. And there isn't a lot of new gas supply coming online. LNG export growth, while there are new facilities coming online in the United States, they're slowly ramping up production, and they're not able to immediately meet the needs of today. And so there's a share of global LNG supply that Europe has to share with Asia. There's a competition for that supply, and that ultimately results in just higher prices.
Yeah, truly suboptimal timing for that Hammerfest outage. So what's been the government response to all of this?
The government has said that they're okay. There won't be any shortages. They've found alternative routes through Germany and other places to get the gas that they need. And they're correct. Gas inventories, while they are lower than normal for this time of year, and while withdrawals were larger than normal in the last quarter of 2024, they still are more than 70% full. There's enough gas physically available to get Europe through the winter. Now, it's not so much about shortages, it's just about price. And as those inventories start to get lower and lower, that's going to increase the price. So yes, there won't be shortages, and Europe has done a job, their part in ensuring that. But as prices get higher, customers start to back out. It's called demand destruction. You saw that quite largely in Germany in 2022, when large chemical producers said they could not operate any longer in Germany. That's a very extreme example when prices were at a record high. But you could see a similar thing where if power prices start to rise, or if there's higher gas prices for industries, then you see a ramping down of demand because they try to figure out how can we try to optimize, how can we try to figure out a way to lower our costs, lower our power bill as we face these higher prices.
All right, appreciate the context. Stephen Stapczynski, our senior energy reporter, we thank you as always. I mean, it really puts into context just how urgently Europe needs to get its act together. And let's turn to the politics now, because campaigning really is underway in Germany's election. Next week, the CSU is going to hold a caucus meeting near Munich. As well, we're going to get a raft of economic data out of Europe's biggest economy, factory orders, an all-important reading on inflation on top of that. We've got Bloomberg's Oliver Crook with us in Berlin, tracking it all. Ollie, we're less than 2 months away from the February 23rd election. So where do things stand now?
Yeah, Lizzie, let's try to tie the sort of economic story with the political story by checking first in on the scores where we're looking at in the latest polls here in Germany. I mean, the CDU is still gaining a little bit of momentum, up to 31% here. The AfD almost breaking into 21%. And we think about this sort of AfD getting a lot of prominence in the news recently, Lizzie, with Elon Musk about a month ago deciding he's got a really great interest in German politics and basically backing the AfD, calling Olaf Scholz an incompetent fool, calling the president of Germany a sort of an anti-democratic tyrant, and really causing a lot of concern across the sort of mainstream political spectrum here in Germany, not least of all for the SPD, in part reasons that, they have other reasons to be concerned because they're still in third. Olaf Scholz's party, they're still under 17%, and the Greens coming in at number 12. Lizzie, what we don't talk about so much is where is all of this support concentrated for all of these different parties. If we move on to the next chart here to the map, apart from Elon Musk, the sort of support for the AfD is really concentrated here in eastern Germany. Remember, this is the former communist East, and even these two regions of Saxony and Lower Saxony, this is being held by the CDU really by only 1 or 2 points. The AfD stronghold is strongly here in the east. When the other thing you'll notice when you look at this map is that there is not a lot of red on it. Olaf Scholz's support across the country has entirely collapsed and is really being dominated by the gray, by the CDU here. We should say that these are polling for state elections, so sometimes people are a little bit more willing to make sort of brave and bold political votes there because they know they won't have quite as much power, but it really shows you the composition of where the support here is centered around Germany.
Yeah, I mean, it's not just German politics that Elon Musk's been wading into. He's been calling for fresh elections in the UK at his latest attack on Keir Starmer. That was just yesterday. But coming back to Germany, the economy, Ollie, really dominating the agenda. Just put this period of economic malaise into context for us.
Yeah, Lizzie, I thought that we've been talking about it for so long, the last 2 years, of the sort of economic decline of German industry and kind of the economic sort of outlook generally being very poor. When we look at the map, so this is since 1950, this is the last 75 years of economic growth here in Germany. As you can see, the post-war period, a really big boost back at about 8%, back in the 60s falling down to about 4.5%, 70s at about 3%, and then the 80s hitting about 2.5%. And really there's that key moment there in 1989 when the Berlin Wall fell in the 1990s, and after that you see that growth has sort of tapered off to about 1.5%, 2%, and about staying 1% and going into the 21st century. I should say there have only really been 8 years of contraction across this whole sort of period of time, and that has been 2 of those have been in the last 2 years. So that gives you a context for what is going on right now in the German economy. But if you switch up the board, there's another story that needs to be told here, Lizzie, and it's not just about economic output across Germany, it is about where that economic output is centered. And you will not be shocked to see that the other map that we just showed about AfD support and the GDP per capita map across Germany are almost identical, right? I mean, the GDP per capita, Germany is still a huge economy. It is more than 4 trillion, I should say, euros. But the GDP per capita, when you look in the east here, is under 40,000 euros per head. That is so much lower than it is across the rest of Germany. And when you look at this, this is a map you can see not just with GDP per capita, you look at where all of the companies in Germany are concentrated. They're all concentrated here in the west of Germany, and really just that huge sort of political, cultural, and economic divide that is really driving the economic story and increasingly the political story here in Germany.
All right, Bloomberg's Oliver Crook, we thank you. Really, really helpful context. And I want to zoom out now to the economics across the continent, because the industrial sector, as Ollie says, really is struggling. But you've also got war raging in Ukraine and this political vacuum emerging in Germany. Now, according to Bloomberg Economics, there was already little chance of a sudden growth revival this year. But now, on top of that, the threat of tariffs is going to further delay the region's recovery. So let's get more now with Bloomberg's chief trade and climate economist, Maeva Cousin. She joins us from Zurich. Maeva, I wonder what could be the impact of Trump's tariffs on top of all of Europe's economic woes?
Hi, Daisy. So there are some big questions on how big those tariffs will be. We've had little clarity on that. It's possible, as we've seen in the first trade conflict, the first round at Trump administrations, that the US incoming administration will be quite pragmatic on tariffs and they will be small. If that's the case, it still creates uncertainty, and we've seen that measures of trade policy uncertainty have soared following the election. It's bad for investment, as some businesses will want to wait to have more clarity, but the economic impact will be small. Now, it is also possible that the US incoming administration goes big on tariff, that they go for the 20% tariff pledge that they have said, so 60% on China and 20% on the rest of the world. If that's the case, we estimate, using a large-scale model of the global economy, that it could reduce US-EU exports to the US by 50%. And we estimate that it's a shock of around 1% of European GDP in the short term, losing those exports. In the longer term, exporters will find some new markets and the economic impact could be small, but in the short term, we would be talking about 1% of GDP at risk from the tariffs if they go for the 20% universal tariff on goods.
As you're drawing up your outlook for the euro area economy in 2025, what are the big questions that you're asking yourself? What's going to shape it?
So we've heard some of that actually just now on the program. What happens to the German elections? What happens to German politics? And as Oliver has just mentioned, the German economy has really disappointed, has really underperformed since the COVID crisis. So basically, we estimate that the German economy is 5% smaller now than it would have been if it had kept growing at the same pace. So it's a big economic challenge for any incoming government. And for now, it looks like it's more a government vacuum that we're going to face. And the reason for that, this very 5% weak demand, was from weak external demand and high energy costs. And that takes us to another big question for 2025, is what happens to Ukraine, to the war in Ukraine? Could we see a settlement? And what would that mean for energy flows into Europe? Although generally we would not probably expect a big increase in European imports of Russian gas following any settlement, mostly because of Nord Stream. And the other question is what happens in France. François Bayrou, the centrist François Bayrou, became the fourth French prime minister in 2024. He still has to pass a budget that sort of reassures market, provides enough consolidation, and goes in the direction of EU fiscal rules, but without facing the fate of its predecessor, Michel Barnier, who was voted down on the budget.
And we talked about ECB President Christine Lagarde's New Year's message yesterday, but I should hate to neglect the SNB. Of course, it's been cutting rates fast and faster than expected, mind. What comes next for the SNB?
Yeah. So the SNB had a little December surprise of 50 basis point cut when 25 basis point was expected. Overall, they've been cutting rate by 125 basis points this year to 0.5%, so very low rates. Interestingly, in December, they found that it sounded like they were less worried about domestic upside pressure on the franc, but more worried about domestic weakness. What we think is that there's little policy space left, but the SNB will still have to deliver more cuts, especially as other central banks keep cutting. So we see one more rate cut to 0.25% in March, with risk tilted toward further easing, especially if the franc keeps appreciating or starts to appreciate again.
OK, Maeva Cousin, Bloomberg's chief trade and climate economist. We thank you for that look ahead for the euro area economy in 2025. But coming up, why London is the best place to be for that cheeky Friday work from home perk. We'll discuss the latest results from our flexible working survey next. So do stay with us. This is Bloomberg. back to Bloomberg Daybreak Europe. To the UK now, where researchers at a think tank say that taxes on minimum wage jobs will have effectively doubled in just a decade after the government's increased payroll levy comes into effect in April. According to the Conservative-leaning Centre for Policy Studies, total tax paid by employees and employers will rise to more than 21% of salary for minimum wage workers. That's up from 11% in 2015. In other news, social media giant Meta is replacing its president of global affairs, Nick Clegg, with his deputy, Joel Kaplan, a long-time executive with staunch Republican ties. Kaplan has been an advocate for allowing more speech from across the political spectrum on the platform, and the move comes just weeks ahead of Donald Trump's return to the White House. Now, a tight labour market and the race to attract and retain talent may have prompted London-based businesses to offer more flexibility to their staff. The results from the Work From Home survey by Bloomberg Intelligence shows that 89% of London-based employers are amenable to remote working, more than peers in other European cities. Let's get more details now with Sue Munden, who is Senior Analyst for Real Estate at Bloomberg Intelligence. Sue, good to have you with me round the table.
Good morning, Lizzie.
What are the main conclusions from the survey results? Perhaps not really what we would expect by 2024.
Yeah, actually, sort of 3 or 4 years in after the pandemic, you would have thought many more people would be coming back to the office. But if you look at the number of people who get sort of 1 to 4 days, i.e. pure hybrid, they're not fully remote, they're not fully made to come into the office, it's still around 70% in most of the European cities. Wow. And in New York as well. Asia is a slightly different picture. In Asia, the number sort of flips around a bit, so it's more like 40% have that hybrid ability. That's because they do have more people coming back into the office.
And where you talk about these regional differences, is that a cultural thing? Is it economic? Can you see trends by sector? Why the differences?
A number of reasons. I think the situation in the workforce is important. So, who has the upper hand? In London and in New York, so far, the employers seem to have been able to get their way more than the employer. And London has always been a tight labour market. We've got much lower unemployment here than we have, say, in Paris. And so I think that's been the case. We have seen some movement between the totally remote and sort of moving into hybrid. But in the UK, in London, there's still only 11% of people that have to come into the office every day, according to our survey. Yeah, and that's 7% in New York.
Wow, because we've been seeing, this kind of bounce back in house prices in the UK, the nationwide numbers this week, mortgage approvals as well. I mean, how's work from home impacting listed office landlords and also kind of where people want to live?
Yeah, putting the two together, I think there are some other differences coming into that. So, for example, the changes in interest rates, of course, changes the demand for housing and where you live and the size of the house, as well as where you work. And not everyone's an office-based employee. But I do think that the main preferences that we saw from our survey for people to come into the office were for networking and, funnily enough, productivity. I'm not sure whether that's because they also feel that the workload, if they come into the office, is less, which is an odd one.
We don't chit-chat in the office.
But, yeah, that seems to be the case. But networking is across the piece. Everybody preferred that. Whereas, on the other hand, what deters people from coming to the office globally is commute times, commute costs. They really are the main difficulty for people to want to come into the office.
Well, it's been lovely having you face-to-face with me in person. Sue Munden, our Senior Analyst for Real Estate at Bloomberg Intelligence. We thank you for joining. We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg.
You look around the world and there's a lot of chaos, a lot of political instability. People are clearly not very happy with our governments. What's going on in South Korea is clearly a mess. But we also have political instability in other democracies like Germany and France. And meanwhile, we've got a lot of geopolitical crises in the Middle East between Ukraine and Russia, and it would be obviously a much better situation if the democracy of the world were stable and united and in trying to stabilize the world. But they're having enough trouble just stabilizing the home fronts.
So how do you strategize, Ed? Does it change the picture for you? Does it change your strategy, or is it just noise?
Yeah. Well, I've been in the stay home camp versus go global since 2010. In other words, from a U.S. perspective, I've been recommending that U.S. investors overweight the U.S. relative to the global economy. And oh, by the way, for global investors, I've been basically saying the same thing. You want to overweight the United States. The United States, we certainly have plenty of our own problems, partisanship and so on. But we're, carrying on reasonably well. The economy has performed extremely well over the past 3 years in the face of the tightening of monetary policy. So there's a certain resilience in our economy, and our economy continues to do well despite our politicians. And I'm not sure that other countries are as fortunate that their economies can prosper and do well if they've got political instability.
So that was Ed Yardeni, president of Yardeni Research, speaking to Bloomberg's Haslinda Amin. And as he says, uncertainty really is the watchword hanging over things in 2025, certainly for the euro, and we're really on the watch for euro-dollar parity. We've got, of course, questions about Trump tariffs on Europe, whether we're going to have another energy crisis, and all that political uncertainty in France and Germany, as we were unpacking with Oliver Crook. So the last time we saw euro-dollar parity was after Russia invaded Ukraine. We keep an eye on that. 102 is about where we're trading this morning. But if we flip the board, that euro weakness yesterday boosted the dollar. And you can see here, leverage funds are their most bullish on the dollar since 2019. You also had, of course, those jobs numbers from the US coming in lower than estimates, suggesting that labour market strength. But this has been feeding into emerging market currencies, closing at their lowest level since July yesterday. So if we flip again, you can see emerging market stocks really teetering on the brink of a technical correction. We also had, of course, China, a terrible start to the year yesterday, if we just hone in on that, the worst since 2016. But next up, the opening trade. Anna Edwards and Guy Johnson are going to be taking you to the open, so stay with us. This is Bloomberg.